Mark Nelson, Director of Commodities with Kansas Farm Bureau. And as always, it's a pleasure to be here. And thanks for people getting on. With that, let's get moving. We really are dealing in a time of a world of uncertainty. And it's always easy, I think, every time you hear anyone who tries to talk about marketing, we always use those words. But, with tariffs, strategic uncertainty, and weather, we really do have a lot more uncertainty than I would say normally, right? Are the tariffs going to be on or are they going to be paused? Are they back on? Or are they going to be paused? We are, what is it, 50 days into the 90 days of our first pause. And at the start of that, we were going to be seeing 90 deals in 90 days. And here we are 50 days and we have one outline of a deal. So I'm a little bit worried about, where this is all going. And until we start getting deals done and we have this uncertainty, I think, in ag, everybody in the world is trying to figure out how they can deal with each other. And my fear is that we're going to become the seller of last resort. And so until we get some of this uncertainty washed away as far as tariffs and trade deals, the worst case scenario for me is that we're going to see prices continue to slide, go sideways to maybe even a little bit lower. And I've got some long-term charts in the back of my presentation. I won't go through them, but basically it would suggest that, if we keep moving, sliding down or sideways, we could easily see futures, corn futures with 3s in front of them, wheat futures with 4s in front of them, and soybeans with 8s. Now that's not a prediction, but it's the uncertainty that we're dealing with. So what I want to do today is specifically, I want to go back through and I want to review wheat, feed grain, and soybean plans, right? Targets, price targets, time targets, etc. See where we are, see where we might want to try to be. But then I also want to provide some relevant, but not necessarily representative examples of how options might be used in both a post-harvest and a pre-harvest marketing situation to help protect us if we do see prices continue to slide, right? So what are some things that we can do? And I say relevant because I feel like I'm using some very good numbers. I'm using KSU cost estimates, which, they're averages, they're expectations, but I think it's about as good a data as you've got out there. I'm going to the Ag Manager website to get a handle on what we might think basis should be on average, and checking to see what it is currently. I went out to some websites of grain buyers to get some costs. But again, all of this stuff I think they're relevant. I think these are good examples, but they're not going to be representative of any one specific field, farm, or a farm operator, right? Everybody's costs are going to be, if you have an average cost, half the people are above that, half the people are below that. And so, farmers, landlords, bankers, we all need to understand that it's not a one size fits all. And this is a dynamic situation. So with that, I do want, as usual, I want to go back and I want to look at some of the registration questions. One of them was, how will the conflict in different parts of the world impact grain prices and profitability? And I'm not sure if that meant tariff conflict or if that meant, Ukraine, Russia, China, Taiwan. On that, my first thing would be this. I can't wait to hear from Dan on this. But obviously, conflicts could blow up, creating a black swan event. But with the world also experiencing tremendous trade uncertainty, I think the outcomes of any kind of a black swan event are going to be very difficult to predict. Again, my biggest concern is flat to slightly weakening prices for the rest of this year, right? The second question we had was, have you looked at the Farm Bill commodity provisions in the reconciliation bill to see how they might change profitability for producers? The answer to that, for me at least, is briefly. I've looked at it, right? Increased reference prices, great, right? That's good. Are they enough? I think arguably maybe not. Increased crop insurance cost shares, especially for those higher crop levels of 80 and 75% higher cost shares. Those are good. I think they're all going to help in the long run, but ... right? But we're hurting now, right? There's, we're chewing through working capital like crazy right now. And unless we have some really good yields, which we might, but we're not going to have very good prices, I think people's cash flows are going to continue to tighten. right? The other thing is, in the short run, we're hurting. It's not passed yet. And it's going to there's going to be a lot of changes in likelihood as it goes through the Senate. So we really don't even know what we're going to be getting out of that doggone thing. And then the other concern I have is at least this year, right? If you look at any trend of prices, we weren't that bad. Things were higher, right, in January, and we've been trending down. Well, if things go sideways, for next year, we're going to be seeing probably reduced crop insurance projected prices, which even though we may end up having better, higher buy up, it's at lower levels. And so I think there's some real concerns out there. And I don't know if there's enough in this farm bill that's going to, really help us in a lot of ways. Okay. But again, it's good. It's good. When we look at options, and this is just a bit of a review, and then some people know a lot, feel comfortable, some don't. Options are contracts. They're standardized just like futures, giving the buyer the right, but not the obligation to a position at a strike price in the futures market. So a put option provides a sell position at that strike price, and they can assist in putting in a price floor, right? So we would buy a put to put in a price floor. Calls provide a buy futures position, so they'll gain with any increase in prices. They can assist us in taking advantage of potential price rallies. And so I'm going to put both of these in different situations, okay? Option premiums are the price of the option. They are what option buyers pay option sellers, less commissions, and they're the most any option buyer can lose. Now, if you're an option seller, you essentially have unlimited risk, just like you were if you had bought or sold futures. So that's a little bit more risky situation when you sell an option. But when you buy, the most you can lose is that initial premium that you paid. Now, one of the biggest knocks on options is the fact that premiums can be expensive. And we'll look at some things that might help us get around that. Okay. Now, specifically today, I want to examine two situations. One is a post-harvest situation on wheat. So let's say we make the assumption we're going to sell that physical wheat, but we listen to Dan and we think, you know what, there's an opportunity for a price rally. So I'm going to buy a call option to profit from any post-harvest price rallies without having to take the risk of owning that grain. We'll also look at a pre-harvest situation of buying a put option to provide a floor, right? Because hey, boy, if I think prices may continue to slide sideways to lower, maybe I ought to get locking in something on my corn or my soybeans, right? And the thing there is delivery is not required, right? If you buy an option or you sell futures versus, say, a forward cash contract. And that can be a good situation if, say, for example, production is uncertainty, right? Let's say I forward contracted 30% of my production, but I don't really want to forward contract and commit to delivery anymore. So I might use an option, a put option, as a way of continuing to get my price protection without locking in a delivery. It's also good if I feel like, well, boy, basis is really weak right now. So I can, buying a put allows me to set the price, and then I can later deliver that crop and set the basis. And again, basis is cash price minus futures. We'll also examine, selling call options to help lower that cost of the purchase calls and puts. Okay. Because again, one of the big complaints, one of the knocks on using options, buying a call or buying a put, is that the premiums can be high. So we're going to look at selling call options as a way of lowering that initial cost of the one I'm purchasing. And lastly, I'm going to try to compare some of these alternatives against many things, like selling futures or forward cash contracting. So you kind of can get a handle on the whole panorama of options that are out there or alternatives that are out there to you. So let's start with pre-harvest wheat plan. Pretty much we're done, right? We're anywhere from, I don't know, maybe a couple, 3 weeks to a month or so away from harvest. So for most of us, I'm going to go ahead and wrap up my pre-harvest plan. Now, if we look at that, what did we do? Well, we sold 10% back August of last year for 588. We sold another 20% in September. Now, obviously, I've missed a couple spots, right? I didn't catch that thing in October of last year, and I didn't catch that opportunity when we saw prices up there above 640 this last February. So probably could have done a better job. But we had a plan, we set targets, and for wheat, it has been difficult to find prices that are going to help cover a lot of my cost of production. And so we had price targets here on the pre-harvest side, which were probably a little bit too high given where the prices were trending. But either way, we ended up having 30% of our expected production priced at an average of 612. Now, if I would have closed out yesterday, right, when July futures closed at 524 and a half, 612 minus 524 minus a penny for commissions, that would net me out 87 cents on 30% of my production. Or if I divide that out over all my production, 26 cents. So again, didn't make a ton of money, right? But we did add to our position. And that's what the goal with our marketing is, just try to collect a little bit on the margins to help ourselves out. We try to do that throughout our operation. So we didn't make a dollar, $2, $3 a bushel. We made about a quarter. But again, that was a positive thing, and we can add that to whatever I get at harvest. So when we think about post-harvest wheat, our goal always should be to better our position versus our harvest values, right? And right now, those are like $4 wheat on the cash side. Now, one thing we could do is store this grain unhedged. What I've got here is a chart, and it's my chart of estimated profitability of unhedged storage of wheat, right? And so what I've got there are the NAS prices charted out against estimates of storage cost. And now the orange line is commercial cost. I'm using 5.5% interest. I'm using a 6 cents per month commercial storage cost. So I add that together, and that's what that orange line is. Prices will need to exceed that to cover my costs. The green line is on farm. I'm using that same 5.5% interest on that value of the wheat at the start, plus a 5 cent in and out charge and 1% shrink. So again, my on-farm storage costs are going to be lower, but as this chart shows, on average over the last 15 years, the only way storage would have paid would have been off-farm, and if you had to have hang on to it clear until May, and that's barely. So again, I always look with a jaundiced eye at storing wheat. And I think most farmers do too, because typically it just doesn't pay. I know the 2024 crop, it has not paid if you did any storage there. The key thing there is cash grain prices have got to rise enough to cover your storage costs and risk, and typically they don't. Now, looking at an example for this year, like I said, let's say we're going to store till mid-February, get us into the new tax year. On-farm storage that I'm using is going to be about 29 cents a bushel until that mid-February period. 60 cents a bushel if it's commercial. Now I'm using about 7% interest for this 2025 crop. And I know a lot of folks have operating notes out there that are even 8 and even 9%. So I'm using a little bit higher cost. And I think it makes me worried about whether storage is going to work. Now you could put on a storage hedge, right? You can store it, hedge it, store the crop, sell futures, or maybe buy a put option. Here you're going to gain from a narrowing in the basis, either because cash prices are rising or because futures are falling because you're selling futures, or some combination of the two. But that change, that must cover your storage costs and any risk that you're taking. So let's take a look at that a little bit. The other thing you could do is sell the crop at harvest and move on, right? Just don't just sell it, be done, move on to your corn, your other marketing. So let's take a look at this. What I've got there in the upper left-hand corner is, I call it a table of wheat futures carry over time. And so the way to look at that is July futures on March 1 were 576. And to carry it for 2 more months, the average carry in the market from September futures to July gave me about 7.6 cents a bushel. From December to September gave me another 7 cents a month. And from December to March was another 5.3. All total, to get me out there to March to maybe mid-February, it was 52 cents in carry. And the thing that we see is in March versus April, it got a little bigger, right? It was 56 cents. Then it was 57. And yesterday when I checked, we were seeing basically 58 cents. And on average, 7.5, 7.7, 6.5 cents per month. Those really aren't too bad carries, right? So we're seeing fairly good carry in the market. I would say that's good for an elevator. But if I'm storing commercial and I'm paying, say, 6 cents a month, plus I've got another, say, 3 cents in interest costs, that's 9 cents. So these kind of carries aren't really going to support me if I wanted to store my grain commercially. Maybe if I'm doing it on farm. The other thing is kind of helping us and making us maybe think, okay, maybe storage could work, is the fact that nearby basis is fairly low. That bottom table shows that. I've got 6 locations: Colby, Dodge, Concordia, Topeka, Haven, and Chanute. And I'm comparing that to July wheat futures as of yesterday. So the 525 futures plus or minus 450, 455 minus 525 gives me a negative 70 cent current basis in Colby, a 65 cents negative basis in Dodge City. And then I went over to the website, and as of say July 3rd, the average 5-year basis is 43 cents for Colby. So essentially, new crop basis is about 26 cents weaker than normal. So we're starting out with a very weak basis. We've got fairly decent carry, and that means, okay, maybe we need to look a little harder at whether storage will work. But please note, in Northeast Kansas, at least these numbers, the places I've checked, basis actually is running better than average. In the central part of the state, it's pretty close, 4 cents under. That's not bad. And so really it's more of a Western Kansas thing and maybe a Southeast Kansas place where storage maybe could work. So that's what this table does, right? We've got March wheat futures, 582 now. And so we're looking at the deferred basis. So in Colby, that's $1.27. And if we look at what is the 3-year average basis in mid-February or mid to third week of February, the 21st, it's 45 cents under. So we would think, hey, we've got an opportunity for 82 cents in expected basis appreciation. Now that's got to cover my storage costs. Commercially, roughly 59 cents. So that would give me an expected return, storage hedge return of 22 cents. On farm, that's giving me an expected storage return of say 54. Again, notice that depending on where you're at, you're going to see different potential for storage. And so again, while this is a relevant comparison, it's not going to be representative of anyone in particular. So the summary of this is this. If basis trends back to average levels, if we see that 3-year average show up in all those locations, then expected basis appreciation appears to be potentially very significant, offering a return to storage. Now, while this is something we need to continue to monitor, we are again anywhere from 3 weeks to say 6 weeks from harvest. And a lot can happen. And I might note that these places like Haven, where we're probably closest, we're starting to see that narrow up a little bit, right? They're closer to harvest than, say, Colby is. And we're starting to see that narrow up a little bit. So something to very much monitor. And definitely in a year like this, if I'm out there in Western Kansas, if I've got good protein wheat in an average protein year, and then I can haul it later on to some place that'll pay for that protein, definitely storage might work, especially on farm. But again, you want to continue to monitor this. Okay, so we had these 3 alternatives: store and hedge, store, hedge, sell the crop at harvest and move on and do nothing. Some other things we could do is a minimum price contract, which is essentially selling the crop and buying a call option. Essentially, we're avoiding the storage cost and risk, and we're trying to re-own this thing back on the board. We could also then do this call option spread, which is sell the crop, buy a call, but sell an out of the money call, the same as that minimum price contract, but selling that call option to lower the price of the purchase called. Now, let me show you just kind of a quick schematic. This is not real numbers. It's just sort of a classroom example, right? So the way that call option spread would work is this way, right? We begin by buying, right? We begin by buying a 490 call. And let's say it's going to cost us 30 cents. So net gains are we're going to begin after futures reach 520. 490 call plus the 30-cent premium, right? Because I got to pay that premium. So my gains begin if futures rally above 520. And I think, man, that costs a lot. So what I do then is I pair that up by selling a 530 call for 15 cents. And what that did was effectively lower that price at where now my gains start at 505. But beyond 530, right, that call is going to lose money, right? And so I've picked up and I created basically a little window there, a 25-cent net upside window between 505 and 530. And so I'm thinking if we see a mini rally post-harvest, I'm going to grab that. But if it goes, if we see a black swan event and it goes up $3, I'm not going to get that. I don't share in that if I use this this alternative. Note, if futures decline, both the calls are going to expire worthless or with little time value, and I'm going to net out at a negative 15 cents. All right, I spent 30, I don't get it back, but I sold one for 15, so I got that back, and so my net was 15 cents. Now, kind of putting that into a schematic, I've got three things here post-harvest on wheat. A, sell the grain. And Central Kansas, it's going right now for 481. B, I could sell the grain and buy a call option. C, I could sell the grain, buy a call, and sell a call. So that's that caller. D is sell the grain, buy a call, and sell two calls. So I'm essentially doubling up. Now that not a lot of people do that. Some there are things called accumulator programs, etc. That some elevators or folks will do that. And so I'm going to kind of plug that in there also. And then on the far right side, I've got the storage hedge and expected cost return. So let's take a look at that a little bit. Again, if I sell the grain at harvest, I'm done. I'm out. I'm at 481. If I buy that call option, it's going to cost me 47 cents, which is fairly pricey. $2,350 per $5,000 contract. And that lowers my minimum now from the 481 that I just would automatically get by selling down to 438. And futures would have to rise to 628 before I start breaking even. So that's a pretty big jump. So that's that situation. Now I would have unlimited, right? I buy that call, and if we see $9 wheat, I'm going to get that gain. Okay. But if I don't see that big of a rally, I've got a lower minimum and I spent some money on that call. So what I could do is turn around and pair that by selling a 660 call. And I'm going to get 23 cents for that. So I add that lowers my cost of my call that I bought. It increases my minimum price to 455. My futures price to break even falls down now to 606. And so I'm going to gain from 606 up to 660. That out of the money call strike. So that's a pretty big period where I'm grabbing that gain. But after 660 futures, they're going to offset. Now, if I double up, we continue to raise that minimum. I pretty much, right? So yesterday, March futures were at 582. I start making money with that thing at 584 now, and I'll make money all the way up to 660. But after 660, I'm getting double the losses. They don't offset anymore. And so at that point, we're really bringing on a lot of risk. We most definitely need to have a strategy and a plan that would get me out of that, right? Get me to sell those calls before that would happen, right? We do not want to go into that and see $9 futures in you owning two calls or being responsible for two calls. On the last side there, under the lighter color, we've got the storage hedge. Again, in central Kansas, basis is a little bit better, but we do have the carry. It's slightly weaker. Expected profit for on-farm would be about 37 cents as long as we go back to those normal basis levels of the expected basis of 35. Okay, I got to start hustling here a little bit. Pre-harvest on the corn side, here's our plan. We priced 20% January. We priced another 10% 417 both times. Futures were at 466. So we're currently priced at 466. Not too bad of a price. From last month, we're going to carry it forward. That third increment, we're waiting to get $5. Right? I want to see that. But we haven't seen $5 since May of last year in this contract. And you look at that downtrend, that's the one that scares me. And in some ways, I get concerned. We'll have to listen to what Dan says, but I get concerned that we may not get past 470. And so maybe if I haven't taken any marketing, if I haven't done anything yet, I may want to, if we can get back up to 470, you may want to grab that. Because if we keep on hitting that line and going back down and trending sideways to lower, we'll never hit the $5. But I'm pretty happy that I got the 30% done. Let's take a look at what forward cash contracts are. Again, December corn futures yesterday closed at 446 and a half. Colby cash grain price, new crop bid was 412. Garden City Co-op is paying 452. So we're basically seeing an average forward contract bid of 419. And if I were to plug, instead of that $5, plug in 470, Both of those would end up covering my direct costs using, that K-State data, my cash rent, and my family living. So it's covering a lot of costs, not like it was doing with wheat. And if I use the $5 target, that would also cover my fixed costs. So, pricing today, I'm covering a lot of costs if I'm worried that prices could continue to slide. Looking at those new crop bids, on average, they're 27 cents weaker than average. But again, note some places, Garden City, for example, that cash bid right now or that new crop bid is actually stronger than what we would normally expect basis to be. So we all need to take a look and know what our costs are. We need to know and then know exactly what our specific situation is when you call and make that, find out what that bid is. But I think there's some opportunities. Again, basis is a little bit weaker, but I think there's some opportunities out there. Now, I do want to talk about that option collar, right? This strategy involves buying a put and selling it out of the money call. Essentially, we're saying, I don't want to lock in on a week basis, so I'm not going to forward contract anymore. So it doesn't lock us into delivery, it doesn't lock in the basis. It provides a higher floor than alternatives that retain upside potential, such as buying a put or a minimum price contract. It also establishes a ceiling, though, at that call strike. So I kind of ran through that already. Let's take a look at how that looks. This is a Central Kansas example, corn. And so in the first column, I've got a forward cash contract. And again, at that time, it was 428. And that's my, if I would forward contract today, that's my minimum price, that's my maximum price. And it's at 19 cents basis, which is weaker than my expected 10 cents basis. I could sell futures. They were 446. December futures were 446. My expected net selling price would be 436 if we come back to that 10 cent at harvest. I could buy a put. Let's see here. Okay. So forward cash contract, sell futures. That's better. As long as basis is average, I don't have to worry about delivering if I sell futures. I could also buy a put option. Let's say I buy a 450 put, but it's going to cost me 31 cents. So now my minimum price is 408, much lower than the 428, much lower than the 436. It's lower, but I have unlimited price risk or unlimited upside potential because, yeah, if prices go up, they can go up $2, $3, $4. If we see some kind of black swan event and I haven't priced anything yet, I can price that at a higher price. But I've got my minimum in there at 408, which is covering quite a few costs of production for most folks. I could forward contract, so I lock in that 428 and then couple that with buying a call to give me upside potential. There, though, unfortunately, I'm also lowering that minimum price a little bit more. Not much, but about, what is that, 13 cents versus just buying a put. Now, the other two things I'm looking at there on the other side, the option collars, those are two separate collars. And again, you need to couple those. You're coupling that with buying a put option, that 450 put. And now we're looking at then selling a 490 call. Okay. Now, what that does is I'm taking that 16 cents because I sold it. I use that to lower that 31 cents that I paid to buy my put. So I've increased my minimum price now up to 422. But now my maximum net sales price is going to be 462, right? Because that once futures go beyond 490, that call option is going to start offsetting any gains that I would get from the put option. Or you could spend a little bit less and buy a 510 call, which then I don't have as high of a minimum, but I have a higher maximum, that 478. With that, again, so that kind of gives you a panorama. I could go a fixed contract, go 428 and forward contract today, or I could look at some of these collars that give me higher minimums, but also can kind of cap the top. With that, I apologize for taking so much time. I'm going to turn this thing over to Dan. Again, always thank everybody for my opportunity to be here.
Mark, thank you very much. And to talk strategies right now is, I think, paramount importance because here we are at just about June 1, and it in some of these marketing years, June 1 with good crop conditions has been the time historically in selected years when we've moved sideways and then started to slide off into harvest because again, no crop threat materialized. So it's the time of decision, and I see what you're talking about there, and that you're looking at some way, especially with the options strategies, to protect the downside and the future side, and that's what the options would do, but allow for what could happen. And uh, I think by the time I get done here on my part, I'll hit some things that I hope will give us kind of an objective weight of the downside versus the upside risk. And again, we are on May the 28th, and just got the crops planted. I've got some rain, and the knee-jerk reaction is to think and buy in completely on to the downside, or not, if not completely, pretty strongly. But there's still some things to consider. So let's go forward. There we go. Of course, we just got some rain. I just drove from Colby, Kansas, in the western part of the state up to Nebraska. I got rained on the whole way in the last there and most of the way back in the last on Monday and Tuesday, and so without doubt, at least in this neck of the woods in Kansas and even up into parts of Nebraska, some welcome rain. Nobody was complaining about that. Still though, you have areas in the heart of the Corn Belt. Again, Iowa, most of Iowa, uh, good part, the crop growing production region of Missouri, southern most the southern half, 2/3 of Illinois, southern Indiana, other important areas that still looking for moisture. And this is just what happened in the last 7 days. The last 30 days, again, these same areas still somewhat dry, and uh, these conditions help for planting. We get the crops underway, get them in the field, and then wait for rain and see where things go from there. In the broader picture, this is a from this is a NASA satellite-based calibration looking at root zone, soil moisture, drought indications, and again, in the blue you see areas of a lot of rainfall. In the uh, in the red areas where it's dry, of course, and look at the date on that, May the 12th. That's the last one that's out. Of course, they trail here. So with the rainfall that we just had in parts of the Western Corn Belt, we'll see how that looks in a bit. Coming into this, you do see some world crop supply demand issues that are afoot. You still have, let's see here, there you go. That's how our conditions look right now compared to the rest of the world in major crop production regions. So again, it's got some rain. Well, pardon me, that's the 26th. So I guess there was something after the 12th. So that on the 26th, you see the moisture that just came. Sorry about that. That's my error earlier. So you can see the rainfall that's come within the last several days, not including yesterday, in parts of the upper Midwest. Still dry out to the west. Still quite wet down into the southeast. Go down into parts of South America. You see the excessive rainfall that's coming down into Argentina and a few small parts of Brazil. That's enough rainfall that they've been indicating uh, uh, well, it's affected their crop prospects in so many words. So that's one factor providing some support to the soybean market. You still have this wide variation in crop production regions in Brazil, and it's I know what I read from the groups that are down there. I know what the USDA says, but man, it still looks pretty dry. So to me, that just indicates uncertainty yet in terms of what we finally have. So when the broader numbers come out in the like the May 12th WASDE report, be another one coming up. I believe it's on June 12th as well. And again, just 2 weeks away. They'll probably still not may look at the downside potential of any of these areas like this. So I think we're in a situation where you'll have to wait till they actually get in and finish up harvest. Now for soybeans, that's pretty well happening. For corn, their second crop, corn's in Brazil. There's still a little bit of ways to go. You do see these dry areas up here in Russia and parts of Ukraine, parts of Europe. Uh, and this map is notorious for showing, well, it's more sensitive. This NASA NASA zone soil moisture map of showing the developing dry areas. I've heard and have had climatologists tell me of that. So it's not a conservative conservative harbinger of what's out there. It tends to show pretty quick what you got. So it does show some dry areas. Russia talked a bit about talked in the last 2 months about slowing down second half exports in of wheat. So and you see the discussions about what's happening up in again Eastern Europe, parts of France, Germany. So we'll see where all that goes. Uh, you can also see in now you're turning drier in Western Australia. It's still quite wet in Eastern Australia. You do see a dry area that's developed that's affected the wheat crop in China to the degree that we caught news of and on the ag marketing wires of government messages being sent out from from the Chinese authorities to farmers to try to salvage as much as they could of their wheat crop. Now, has China come charging into the U.S. wheat market and started to buy it? At least not directly. If they have, we don't know how to identify them. But the point is, this is something that's out there in the world wheat market that will bring demand from someplace. As you start trading places and then have kind of transshipments here, there, wherever, that could have an impact on things. Not much happening at this point, of course, and we see what's happening in the U.S. wheat price arena, and some dry areas showing up also in Africa. Feed grain markets. Pulled this up this morning at about 9:49. I've got a side screen over here I'm looking at that shows the July contract down about 7.5 cents, about 4.55. I've kind of been watching the DEES contract as kind of a indicator index of what the thoughts are of the market heading forward. We tend to hang around 450. We had been down to, I think, below 440 once for the DEES contract in the last couple, 2, 3 weeks. On some more positive news, it got to 450, 455, thereabouts. So that's Mark, as we talk about the long, slow slide that can happen. I think most of the movement and the lows that have been coming in the last several years have tended to come in September. And I don't know if we indicate that, or if we suspect that comes mainly as the USDA's NASH reports come out. They indicate either large crops or not. And when they've come out with large crops the last several years, well, it's been the markets, and again, coming out of that WASDE crop production report in September, taken a hard hit. And so that's probably where things are. If the low that we'd see is probably in September, but we don't harvest our crops till December in at least in Kansas and most of the U.S. Corn Belt, and well, October, November, December. So we would see where things go after that. Here's the patterns you'd seen for the July contract. Again, yesterday's closes. It looks like it'll be down again if we're not that far from another 7 or 8 cents down, but we're basically trading somewhere around, as you can see here, about 437 for a low here of late. Got up to about 465, 459. It probably looks like it's about 461 or so. I'm unsure exactly what I'm seeing on my side chart, but anyway, we're kind of hanging around in terms of, again, this is a deferred old crop contract and showing that movement. Now note, I try to watch the relative strength indices for these contracts here. You're hanging around 50%. So it's a market that's kind of trading sideways right now in terms of the technical indices and the fears of the market. I think we're waiting to see what happens. Basically, we see the moisture with also out there, and Chip Redman from Kansas State University, other climatologists have talked about their fears of this being an analog year where once we get past the moisture in May, and during the May planting season, they've seen years like this turn drier. So, Mark, I know, and Rich, I know what that makes me sound like. That makes me sound like some guy beating the drum for higher prices. I'm not trying to do that. I'm just trying to remain balanced in perspectives on what the possibilities are for how these the markets would go the next 90 to 120 days. Where are we at historically? So basically, again, It's a monthly chart on yesterday. Well, pulled that off this morning. Last number they had was about 454 and three quarters for a monthly high-low close, and you can see that up here listed in the where they're at for the recent numbers. And of late, if you from a monthly view, we've been as low lately as 385. We've been as high, and it didn't last long, about 518, 520. So now we're about 450, 454. And Mark, I take quite seriously the comment that you'd had about the riskiness of the market and where it could go and how it could have a three in front of it. We've tended So if this 385 was the low, and we're wondering where things could go, well, it's certainly something lower than 450. It's closer to like a 390, something like that. In so many words, if we see the market continue to avoid any worries about where prices could go in corn, then it probably heads from 440, 450. Well, it heads for 425, it heads for $4, etc. And the problem with options, it's a matter of perception. And at this time, 25 cents seems like an awful lot of money to spend until we go to 425. and then it would have been pretty good money to spend. So that if we go with the options, we and Mark, I'll make this comment and invite you to for feedback on it. If we spend that 20, 25, 30 cents, 40 cents or something, we're basically positioning ourselves for a move beyond what we spent. So if it's 450 now, let's say it's 450, we spend 30 cents for an option or 40 cents. You're looking at 410 to $4 before that thing starts to make a profit. If you're looking at a new crop contract, what are your thoughts?
Yeah, that's exactly right. On that one slide, I was looking off of yesterday. You could buy a 450 put, would cost you 31 cents, and that puts your minimum price at 408. So, you nailed it on the head there. And that's the thing that locks that in for us. And to your point, our point, if things continue to look good, if this trade war extends a little bit more, maybe we end up starting to see some retaliatory tariffs. Most definitely. That 408 may look pretty good. But the good thing about buying that option is that it does then give you the opportunity that if we do see a rally, right? If things tighten
Yeah.
up, if it gets dry, hey, then I can sell my crop for a higher price and I can do better. We're just setting a floor at that point.
Yeah, we're trying to handle the uncertainty of the moment, and what we're doing other than just hoping is to try to quantify the risks with these options. So, did want to show you the movements in the market. You can see this fall off in the the short positions of managed money traders, i.e., the speculative position folks. And we had grown into really a record high long position in the first 3 months of the calendar year. Uh, Basically 2.225 billion bushels long positions, and during the same time, pretty minimal short positions. Of late, with the moisture that's come and the prospective plantings report, with higher corn acres, etc., that's fallen off now down to below a billion bushels long and probably about 1.4, 1.45 billion bushels short. So the market, for those wondering, what's the market thinking? If you look where it's put its money at, the market's shifting more bearish, but not, it hasn't fully bought in. If it fully bought in, it'd be challenging 2.5 billion, 2.6 billion in long in short positions. So it's trending that way, and it's just about June 1, and it's watching the weather. And would say in terms of what the markets are bidding, there's a way that in about really the same way the USDA figures season average prices, you can go into the futures and project into the future into the next marketing year and see what the futures are thinking right now. So the USDA at this point in their May WASDE report projected $4.20 for the season average price for the 25-26 marketing year starts September 1. If you go and use the most recent basis data we have and take that forward with futures and weight wait the months, wait the periods with the same percentage cash sale figures that the USDA uses, it looks like the futures are thinking more along the lines of about 456. Well, voila, there's 450 again, but really more of a 456 view, whereas the somewhere between $4 and $5, about right in the middle, whereas the USDA's projections are about 420. So when the USDA comes out, and if they come out with another $4.20 figure, which they very likely will, they assume normal conditions all the way through to the end of the crop year. So they'll look at June 1. Well, basically, NAS isn't out in the field yet. So you have pretty much USDA ERS World Ag Board trend line projections. If they don't come off the 181 right now, why would they? So come June 12th, you'll see a supply demand balance sheet very similar to May, very likely, if not identical on the production side. And if that holds up, you probably won't see much difference in the price, and the futures will adjust accordingly. And those that take what the USDA says as the absolute best information, and how can we argue that it's not? It's probably going to come out with 420, and around that report, that'll be a negative set of information come in. That'll come in unless we see a preponderance of drier conditions or other problems come in and affect the market. And that'd be around that June 12th report. Cash prices in Kansas right now for corn, about the Garden City area, still a bellwether for Kansas, 457. Even money bid on basis in the Garden City area. This was as of yesterday. 451 new crop price, 5 cents over. That was the top one. There are less than that, but that was the best. And you can see where basis is at in Kansas, around other parts of the state. And right now, that of course, if you're in Garden City and you look at the soybean corn price ratio for new crop corn versus soybeans, well, the cash price new crop bid for soybeans is about 210% or 212% of that of corn, and 2.3 is neutral. So definitely favoring corn. Interesting, Colby area neutral, favoring soybeans, Salina, Topeka. And again, we probably, with what's happened, we're still getting later to plant corn now, but we still can plant soybeans. And you also see that the corn price, even at 457, which we don't think is high, is almost par, 101% basically of the wheat price. So very likely you're encouraging wheat feeding, especially with wheat crop coming on. If it avoids disease issues, any other maladies in the next 30 to 45 days, there'll be supplies of wheat around Southwest Kansas, and it might be very likely probably be a feeding opportunity for cattle feeders that want to go that way. Just in the interest of moving pretty quickly, I'll show you some slides. Encourage you to go back and look at them later. Basis in light of these corn markets, weak. You see the blue line. Topeka, the basis 50 cents under. Dodge City, basis even money. And you can see that that's the 2025, the weekly basis numbers. 0 is even money, 50 cents over. We basically spent most of our time the last several years somewhere way above even money, but now we're hanging out at even money. Even though around the state that's the best basis there is, that's still a pretty that's not a strong basis historically at all for us. And you can see a pretty weak basis in Topeka as well, indicating there's not a lot of localized demand coming in and saving the day on grain prices. So generally lower futures, weak basis, just a tough time right now. Did want to show you here when NAS comes out, the 181 bushel an acre projection, then you can see how that compares historically. Last year we're 179. We had been about 176 thereabouts. Depends how you want to look at it. You can either say, gosh, it looks like we've been level for a long time, or you can say, well, gracious, it looks like we're moving higher here in one or two of these years and here of late. So we'll see. In my own thinking, I'm more inclined to be worried about worried about us being able to attain that 181, given that, yeah, we're looking great right now. It's probably a 35% chance, one third that we'll hit that level. But, we still have all of June, all of July, all of August, and September to get through. Did want to show you just you can look at this and to see what usage is. Really nothing that's tremendous there, except that grain sorghum, pardon me, corn exports are doing great. And we have we have a tie for the strongest corn exports that we've had since since back at least 2020, 2021, 2014, 15, pardon me, 13, 14. So we have the strongest corn export pace that we've seen of late. And if you ask me that question, I'll stumble around and say, well, I know things that contribute to it. Generally lower prices, a little bit weaker US dollar, Brazil looking to expand its domestic biofuels industry, uh, uh, some worries about production in different parts of the world. You bring a number of things together, but we've got good corn exports, and it's a positive thing. And a good chunk of it going to Mexico, Japan, Colombia. We show this chart 3 or 4 years ago. You'd have China in there. China has stepped out on corn exports. They pretty much stepped out since about the first 1 or 2 months of the year in sorghum exports. Also, corn stocks. I uh, to me, there's a surprising number on here. Here we've got the 15.8 billion bushels of corn corn production projected for this year. And you'd think with that, gosh, we're looking at 2.5, 2.7 billion bushels of ending stocks. The USDA came out in their May supply and demand balance sheet and showed strong usage. Well, and that usage, that's these numbers. Again, strong exports, strong feed, ethanol staying level, wet corn milling, 1.8 billion bushels of ending stocks. So you come in with that 1.8 billion, about 11.6% stocks to use, and 11.6% stocks to use, $4.20. And I get it. I see why again, it's not $6.5 like we had when we were below 10, but given these projections, we're at about and the balance of all the other factors affecting the market, projecting pretty conservatively at $4.20. My own thinking, and so uh, Mark, I appreciate you aiming a spotlight on this. You know, when you have a contrarian view, I'm not sure you want to find the spotlight. But anyway, as a thought, certainly the chances of us getting that 15.8 billion bushel corn crop the USDA is projected, they're going up. I had that like at 30% last month, 35%. Still only June 1. We've got moisture right now. Still weather forecasts that are not in agreement. Some pretty bearish production wise. So I'm still thinking more along the lines of tying the previous record rather than setting a new one. And that's about 179, about 40% chance of that. And again, still open book, 25% chance of something worse coming in. But if you come in with this and you keep the usage at about the same, because you'll have plenty of corn, 15.6 instead of 15.8, then you're at 1.6 billion bushels. 191 million less than that, you're 10.4. Instead of 420, you're more like 460. And the futures are projecting, we just showed it, about 456. So I think that the market is thinking more along the lines of this than the 420, at least right now. And you can see that chart wise. And I could talk a lot about the world numbers. World stocks, 13-year low. Then for stocks to use. So we're not just a wash in corn. And what's surprising about this is with the 25, 26 marketing, you're in there, that the Brazilian large crop in there, the US large crop in that. And even with all that, we're still seeing ending stocks at a 13-year low. So I don't know what to tell you on that other than I know up front we're pretty pessimistic, but we're not just awash in corn in the world to where dry conditions could interrupt the narrative of outrageous plenty and not lead us to higher prices. So I know where we're at, and I know why we're thinking it, but there there are factors to still be thoughtful of with regard to what could happen to the markets if we don't get the current projected 181 bushels an acre. And you can see the kind of where the world numbers are, the tightness, and we've talked about this before, how much of the world stocks numbers are in Chinese hands, how much are not. That 96 million metric tons is the rest of the world. This difference, that's all in China. And you can see that world less China stocks to use hanging around at 9.5 to 10%, pretty low. Grain sorghum has been challenged. I think the main issue with grain sorghum, these lower prices, these wider basis levels. Again, the Garden City 382 top price, 75 under. We were at even money with corn, if you remember that, and it's a tougher situation. And I think it all comes right back to this. And we started out pretty decent in terms of exports, and then U.S.-China trade issues started to come into play. And let's see, that's uh, uh, with the marketing year starts September 1. That by the time you get this many weeks in, that's about 5 weeks. That's just about a changeover in U.S. administration signals that um, there'd be trade discussions, trade issues to be dealt with, and with that, at that point, grain sorghum exports pretty much flatlined. You have number of weeks where nothing happened, so it's had an okay year going, and then pretty much stopped. The other side of that is if the U.S. and China, which are in these negotiations now, if they agree to go forth, this could also be the first near the first U.S. ag crop that would benefit from that, because gosh, the supplies are there and the capacity is there to send it. So we'll see. And usage trends, the USDA is projecting a great recovery next year in U.S. grain sorghum exports. So they're in their view, as they project the 2025-26 marketing year, they're projecting back up to 250 million bushels of exports, where we'll probably be at like 60 to 80 million bushels by the time this marketing year is done, given the current pace if there's not an agreement. And so you'd have going from weak year to tremendous recovery. And that would be great news on the grain sorghum side. Okay, so it's the top of the hour, and I'm going to hit some things really quickly. I promise we won't be here in 12 minutes. So here we go. Soybean markets, November 1041, again, still above 10, but we're hanging around 1050 until we know something better when you look at November. And if anything, though, of late, some of these issues in South America and others have given us some strength. Note that from an RSI, relative strength index point of view, there's been sideways to some positiveness going on in soybeans of late. So, amen, great thing. And you see the 1052 on the monthly chart. We've been as low as 947 in the last 6-7 months of late. Last year, been as high as 1258, and so we're just about in the middle. We're $2 off the top and $1 off the bottom in terms of the range we've been trading of late, and you can see the wider range thereon. So, Mark, look at this, and if the markets say, hey, we've got great crops coming on, we're not going to worry about it, they probably go towards $10, towards 950, and then decide where they're going to go. That'd be my take on it, but that's not set yet. And what are the future traders doing? Interesting, that little uptrend, the uptrend we've seen for soybeans, you've seen the long positions for the speculative traders actually rebuild some, and some weakening of the short positions. So that's a kind of the inside baseball on the psyche of traders in the soybean market. They're not as bearish as they have been at different times. We had out here in 2024, middle part of it, we had the record bearish position for managed money traders, 1.2 billion bushels, and now we're closer to about probably 450 or so million bushels short, so a third of where we were when we were really bearish. What are the futures thinking? USDA is projected 1025. The Again, you look at the season average price calculations that we can do independently. Looks like we're thinking about 1073. So again, the USDA comes out on June the 12th, and they'll probably say 1025 again, or 1020 or 1030 or wherever. But the futures right now are trading more along the lines of 1073 or 1070 to 1075. Cash prices in well, strongest cash price by far, Topeka area. Of course, that's just north of Emporia. So you've got a plant there. You actually have another plant. It's open down in Cherryvale in southeast Kansas, not that far from Pittsburgh. And so you've got that going on. Hutchinson area, kind of a hub for export movement. So you see a mixed bag of prices, weaker out to the west, farther away from the processors, from the export locations. But there you have that. And generally weak basis, no different story there. USDA also projecting, again, highest yield we've ever had, 51.9 and 51.7, and last several years are projecting 52.5. It's open to at least questioning whether that's going to come about. And again, exports, okay, middle of the road, you can see the pace. Soybean exports, the first part of the year, China came in, bought a whole bunch, and was very active. And still, when you look at what we have right now, China is still for the marketing year, almost majority of the movement. But a whole bunch of other countries coming in. Mexico, Spain, others all coming into play. And generally, we've been when exports have been struggling here of late. We've seen biofuels crush hold up strong, projecting record high crush for the new crop marketing year. And stocks to use 295 million bushels projected by the USDA, actually lower than the last couple years. I saw one analyst say, well, we're tightening up. Well, we're kind of tightening up. Really tight would be 250 or so, 274. So we're getting in the neighborhood. 6.7% stocks to use instead of 8 thereabouts. But those prices, instead of 995, about 1025. It's my own thought again. I see what the USDA is doing. I don't begrudge 52.5. I understand what they're looking at trend lines. They're assuming normal conditions. If you have the view of, hey, almost record yields, still, if any, probably as likely, if not a little bit more than their absolute record high, 51 bushels an acre, you come in with, instead of 295, well, you're down to 233 million bushels, 5.3% stocks to use. And by my own calculations, instead of 1025, that comes about, you're at 1150. So this situation, this real sensitivity is brought about by the drop that we had in planted and harvested acres. So when soybeans came down about 3 million bushels, 2 or 3 million bushels in the prospective plantings report, in terms of the amount of planted harvested acres going to come in. Well, it just tightened things up. We have ongoing pretty strong usage, and we just dropped the base for crop production. If we don't have record high yields, it doesn't take long till we get a pretty reactive soybean market. And of course, we get really dry, then things go elsewhere. So you look at that, and so Mark, I'm open to on the site. You can say in the chat, O'Brien's a nice guy, good enough. I get along with him, but man, sometimes he's a wild optimist. And maybe you're right, but sitting right now, we just, again, there's too much out in front of us to just say 1025, 950, or 995. We're going down. There's just a lot of uncertainty to have to deal with. And you can see that the world numbers, not as tight a situation. Again, betting on large soybean production next year, in the next calendar year, before August in South America. let's finish up here in wheat. Uh, so really, uh, right now it's kind of a crop insurance. Crop insurance comes into play. We had a 590 uh, price to begin with for hard red winter wheat as a planting price, and I believe is June when we was we're just about to enter into the time period uh, when we will be figuring the closing price for the harvest price for wheat, and that's going to be closer to 520, 530, something like that, than it is 590. So it looks like again we're probably heading for a year uh, where we'll have 60, 70 cent differential, and for anybody that has a loss, they're going to be paid probably at the 590 unless something really changes in the market. And so yeah, July contract 527 and a half. So 527 and a half comes in. If that ends up being the average here, then yeah, you'll if you have a loss, you'll be paid out with the higher 590 price. Trending down of late. Again, spending a lot of time here with RSIs, pretty low, downward motivation. Did hit down to $5 of late, ran up to 550, not 524 and a half. I don't think that we're technical traders here for the most part, but you know what? That looks like a 50% deal to me. Between high and low, and we don't know exactly where to go. Well, let's go to the middle. And 524 and a half, just about in the middle of the 550 to $5 range. And longer term, they're 527 as a 527 and a half as the closing price on for the month as of coming out yesterday. The way they calculate that, we've been as low as $5 here of late. It seems like a distant memory now. We're up to about 7.5 within the last within in 2024, but now we're in the low fives, and you can see where we've been at before. And the fear would be of just of ongoing pessimism in the market, and you break below this into the $4 area, and you're spending a lot of time in here where the market not too long ago spent that time. When what's happening, bearishness, turning really bearish on the managed money traders. They're long position, almost at record large short positions. The record large back in 2018-19 were 574, and we're approaching harvest. You could that's a fair speculation as to whether we'll break that record, and unless there's a crop problem or exports really get going, you'd wonder about that happening. The markets are projecting about 543 for the next marketing year starting June 1, a couple days, and 530 is the USDA's projection, so not too far off each other. And the cash prices coming into harvest, 461 Garden City, Colby 446, new crop bid 456 in the area, 505, 506, 505, 506, etc. Salina, Topeka, Hutchinson. So that's kind of where we're at. With harvest just around the corner, just above $5 at our best bids, and if we get a glut of wheat, then that's you probably go lower. And the average bid, bring this up, part of the average yield. There's concerns in the northern part of the state, and parts of the western part of Kansas, west central, about rust. We've just had a bunch of moisture and moderate temperatures here of late. I don't know what that does in the next bit of time. That really need to get Lucas Hagen, Jeannie Falk, my colleagues on here to talk about the likelihood of where diseases go. But coming into these rains, we did have quite a bit of pardon me, not rust, mosaic, pardon me, damage, some fair amount of damage, risks of getting worse damage, and so we'll see what happens. But that's a quiet factor that's out there. If you get rust and then get shot of hot dry weather under stressed plants, then that's the risk that we'd be facing. You can see exports, generally okay exports for wheat. Really soft red winter and white wheat are doing tremendous for exports. Hard red, we're tracking towards the low side of where we've been. A lot of world competition. You can see the different classes of wheat. I wanted to show you so the USDA is projecting 47.1% stocks to use $5.30. And here you've got looking at different scenarios. Uh, it looks like to me that for the marketing year the USDA is going to fall probably about 20 million bushels short of its projection of for this old crop marketing year 820 million bushels. So new crops stocks go up by about that amount. You can see instead of 841, they'll be about 860. Got that plugged in. Uh, the opportunity for either as a coin flip, either higher yields or lower yields, depending on weather as we close out spring wheat, hard red winter and spring wheat. And with that, you're going back and forth. Probably the best scenario out of all that, from what the USDA is projected, is that, hey, it'd be a great scenario price wise, not very good yield wise, is that, hey, we do have crop problems in the last 60 days here, and we tighten up stock some and we end up with like a 601 average price. Otherwise, we're kind of mired down right now coming into harvest at $5 to $5.30 for a US price. Okay, and just finish things up. Got all this happening in the world. Still, world stocks to use at 11-year low. You can see the general trends. So this is so I've heard the question coming in was, well, what happens with trade deals and what happens with the uh, reigniting of the well, I don't know if you could say it's reigniting of the Ukraine Russia war, because that's been going on. What's been mitigated is the world's concern about it. I think it's because they saw what the world did about 2 years ago to move everything they could out of the way so trade could still happen. And so the world right now isn't that concerned about that war stopping uh, the free flow of wheat and other crops coming out of that part of the world. It's not. Rockets flow. So what? The crops can come out of there. We've worked it out. So if something would stop that flow, then that'd be something different.
Dana,
Yep.
Mark, this is Sandra. I have a question.
Yep.
Okay, you kind of talked on the tariffs and what effect that can have on it, exports with China, Japan, Mexico. Going forward from here, what is your prediction? Is it going to get worse before it gets better? Or what's the trends here?
Well, Mark, I can take the first stab at that if you'd like, unless you would want to.
Go
Um,
ahead.
well, thank you, my friend. Anyway, I think that uh, I have a couple thoughts. In the short run, the tariffs that are slapped on have basically been used by the administration as motivation for countries to come and negotiate with them. And then, so I mean, then, and we've seen this happen several times to where the first, and what's happening right now with China, again, 125% tariffs. Well, suddenly we're in a 90-day negotiation window. And you've seen that happen with both Canada and Mexico. Here in the at the was it April the 2nd, I think, when those first tariffs came out. So it and we hear word of countries coming in proactively to negotiate. It does seem that the U.S. government would like to have some minimum tariff set up, and I don't. And they have their motivations and goals to protect. In some cases, it's protection of domestic industries. Actually, some of these tariffs carried over from previous administrations coming out of the Biden administration, and it was both parties agreed that U.S. Aluminum and steel industries needed some type of tariff protection, and what they're aiming at the big offender, if I use that term, at big accused offender, is China with the government subsidized industries that producing goods below cost and then dumping on these markets. So the trade issues are not new. They've been going on for a long time, and what really you're getting at the issue whether countries want to proactively deal with them or not. Now, but the longer term of this, I think, Sandra, is that if the U.S. becomes they play a dangerous game in that you can give countries motivations to go elsewhere to buy their goods other than you. And the poster child impact is that from the Carter administration decades ago, when they I think it was over Afghanistan, coming into the Olympics one year, embargoed wheat sales from the United States into Russia. Russia at that time was a huge importer of wheat. Well, Russia now is the world's #1 exporter of wheat. We gave them all that much more motivation to not be dependent on what they saw as an unreliable trading partner. So in the short run, you're trying to rectify wrongs and protect your industries. In the long run, you run the risk of at least in my view, as I understand it, of encouraging countries to go elsewhere to deal with countries with other potential suppliers that are less political, that they view as more reliable trading partners, especially if you're dealing with food goods. So I hope I've said that in balance, because there are two sides to it. And if anybody talks about this down the road, please present both sides, because I see what's happening in the short run. You're looking at trying to protect some domestic industries, et cetera, from lack of exploitation. But in the long run, you run the risk of pushing away people that might want to buy your goods. Mark, what do you think on that?
Well, I think you're absolutely right. And, and that's did a meeting here a while back on the tariffs and things. And essentially, I think the administration is trying to thread this needle between bringing people to the table and negotiating better deals. And that's defined by country. But the problem is, like I say, we lay them all out there, right? Then we pause them for 90 days. Well, like I say, we're roughly 50 days into that 90 days, and we've got one outline. And so, at some point, he's either going to have to kind of walk all that back with not much in her hand, or to get some things done. And I guess that's, and that's what markets are doing right now. We're just kind of treading water to kind of figure out, are we going to put them on and then everybody start retaliating? Or, where is this going to go? And nobody really knows. And, but I think we're starting to get, more and more pressure, because if this continues, the other side of that needle that we're threading is that we could slowly push our economy into a recession, which decreases demand for our products, and it obviously is not good in any way, shape, or form. It puts more people out of work and things like that. So, he's trying to thread that needle, and we got through July. We'll see where negotiations go.
And there's a new word for us to look up in the dictionary, and with regard to that applies to these type of negotiations, especially when both countries are trying to save face and they have domestic industries they're trying to protect. I think, and it's called brinksmanship, which is we wait till the very end to get forced into a corner and then we do something. But who wants to give in on these important domestic issues on either country before you get to that point?